Hey everybody, it's Mark Arnstein, Remax Hallmark, and of course livingnorthtoronto.com. This is vlog number 76, and today we're talking about the latest updates with mortgage rates. So today I thought we'd have our resident mortgage expert, Mr. Peter Puzo from Dominion Lending, top producers. Peter's always been a wealth of information for us. He always comes in with the newest and greatest what's happening in the mortgage world. And I thought especially today was super important because of the fact that there's been so much change going on lately. And I think people are kind of going, what's happening? Like, do I need to be freaking out or do I not need to be freaking out?
Yeah.
And I thought, let's simplify it. Let's break it down and get everyone to understand really, truly what is going on out there and what's happening. What do you think?
Listen, the timing is great. So, the Bank of Canada, we have inflation concerns here in this country. It's not news to anybody. And the way the Bank of Canada combats that inflation is by increasing interest rates. So what they're trying to do is take money out of circulation, which in theory has downward pressure on inflation. So we have increased interest rates. We had a quarter point in March, half a point in April, which may have been a little bit more than some of us expected. So in a very short period of time, variable rates went up 0.75%, which has set in a little bit of panic. So as a consumer, you sit at home and your payment really hasn't changed for a few years. And then you get that letter in March, payments going up. You get that letter in April, your payments going up again, panic sets in. So we're gonna talk about what the consumer should do.
Right, okay. Now, but let's think about this though logically for a sec, right? So if you, before the rates start going up, we did the math up here really quick, but I'll get in this one sec. But if you had right now, at the old rate before it started to change, right? Which was at 1.75?
Yeah.
Roughly?
Yeah.
Okay, so which would be what per $100,000 then at that point?
Around 350. Around 1.75.
At 1.7, so 350.
Yeah.
So basically right now with the current rate being at 2.5%, we've gone up $45.
Per 100,000 per month.
Per month,
Yeah.
45. So it's not like it's a massive increase,
no.
right?
Keeping in mind, like you mentioned before we got on this this video, that everyone's being approved at the stress test rate of 5.25. So this is all built in.
Right.
Just to recap, it's $45 or $40 per 100,000.
Right.
Right. So the client that is carrying a $500,000 mortgage might have seen a $200 monthly increase.
Right.
From January to the end of April.
Right.
Which still, again, based on everything should be affordable based on how you were approved in the first place. But yeah, right now we've got quite a few clients that were pre-approved 60 to 90 days ago, and we're having daily conversations with those clients to do what they can to take advantage of those pre-approvals.
Right.
Because we still have, fixed rates at that time, a good full percentage point lower than what they are today.
Right.
So that's 100%. Those customers, any of you out there with pre-approvals, should be getting something, pen to paper and buy something.
Okay, so let's look at this real quick. So we got a 5-year fix right now is at 4%.
Today's rates, ballpark,
With the 30-year amortization, so it means that you're amortizing the mortgage based over 30 years.
Correct.
Right, with the payments. Yeah. That's gonna run you $475 a month per 100,000.
Correct.
Right?
So $1 million mortgage is $4,750.
For simple math.
Simple, yeah.
Exactly. Now, if you did the variable, right, based on today's variable rate, which is at 2.5% for a 5-year variable, still amortized over 30 years.
Correct.
You're looking at $395 per 100,000 or $39.50 per 1 million. Basically.
Exactly.
Yeah, what you just said.
Yeah.
So, it's still a substantial difference in cost per month when you look at it from that standpoint.
It is.
So,
and then we added that second bullet here just for purposes of full transparency. The Bank of Canada hasn't stopped raising rates. They're going to continue to do so. The next meeting is on June 1st. Depending on who you speak to, I think the general consensus is another half a point increase.
Right.
Which would take us to 3%. If there was 75 basis points, it'd take us to 3.25, which we gave the example again, another $40 bump per 100,000.
So
still, it's important to understand that these are still historically very, very low rates.
Yeah.
Very low rates.
And I think that's the key, what you just said. These are still historically very low rates. The sky's not falling, would you agree?
100%.
Okay, so it's still definitely a good time to borrow.
Yes, and the one thing we emphasize with our clients is, every bank, every broker has their own opinion.
Right.
I'm I'm going to leverage my 23 years of experience and tell the clients to go variable.
Right.
And prepare them for the increase.
Right.
Because a lot of it's just, just communicating and having them, it's that shock of, oh, I didn't know the rates were going up. But if there's that communication, they expected it, it's no big deal.
Right. And again, we go back to what we just said earlier too, which is about the stress test, right? So again, if someone's going into the variable rate, they're already being stress tested for this bump and that much, plus a bit more. So
up to here, so remember, the stress test is the higher of 5.25 or your contract rate plus 2%.
Right.
So if they were getting into a variable rate at 3.25, that would actually be identical to the stress test rate of 5.25.
Right.
Clients that are opting for the 5-year fixed at 4%, we have to add 2 points. So they're being basically qualified at 6% interest rate.
Almost back where I was in '97.
Close. Yeah, close. So I think it's important that the message to everyone should be, speak to your mortgage broker, speak to your bank before you panic and lock into a 5-year fixed at 4% plus.
Right.
Have that conversation to truly understand what's happening and don't make a mistake.
And do you see with the fixed rate though now, we talked about this earlier, do you see this kind of stabilizing?
Yeah, I hope so. I hope that, 4.25, maybe it peaks at 4.5 and we get some stability.
Right.
I'd be surprised if we continue to see the trend to go north of that.
Right. And with the prime?
So again, I know I'm telling my clients to prepare for at least a 1% bump for the rest of the calendar year.
Right.
So maybe 2 half-point increases. I think at some point the Bank of Canada has to pause and see what the impacts of those rate increases have done. I'm not an economist, but the impacts don't take place overnight.
Right.
It takes time for this data to trickle in.
Right.
So I would expect a pause at some point in the near future.
Okay. And then going into 2023, do you see it kind of like, maybe going back a bit, or do you see it?
I think it all depends on what happens.
Right.
If we see the, inflation number come down to, 3.5%, because currently it's over 6%.
Right.
Then the bank will say, hey, mission accomplished.
Right.
You just got to be very careful, obviously, and this is why we pay them the big bucks, is that if they overshoot and go too far one way and inadvertently push us into a recession, well then, historically, the only way you fix that is by lowering rates again.
Yeah.
So we'll see. Hopefully that doesn't happen for everybody's sake.
Right. No, for sure. But I mean, I think you might say they're giving themselves a bit of cushion, so they have that room to play with, right? So they can have that option to pull back, or
and they're also well aware that more than ever, a good portion of the population is on a variable rate mortgage.
Right.
So the rate increases will have more impact that they may have in the past.
Right.
Because there's less disposable income on a larger portion of the population.
Right. Now, and the other thing I get, this gets brought up to me all the time, is like, oh, there's going to be all these like foreclosures and people are going to go, and I'm like, no, it's not going to happen, right? Because
I don't think
anyone who got into who say bought into the market 3 years ago, let's go back into, or look at it from, just as the pandemic started, and let's go back and say the beginning of 2020, right, where the rates had started to fall at that point. They're only going to be, right now, they're in year 2 and year 3 of those mortgages. So they have another 2 years or 3 years to even go before, if they did fix, before those even start to expire.
Yeah.
Right? Not to mention the fact, again, stress test has always been there.
Correct.
So they were already pre-qualified based on the stress test to get into those mortgages in the first place.
Correct. And for the small percentage of those that maybe get into financial issues, job loss, marital split up, there's that equity now that's been built up over the last 2 years where they can exercise that and provide a cushion for themselves.
Yeah.
So foreclosures, power sales, and Canadians are good payers.
Yeah.
The arrears ratios are well under 1%. They have been for a long time. So I don't see that happening.
So if anyone wants to reach you and get more information, get pre-approved, obviously we always say this, what do they do? What's the best way to contact you?
They could send us an email, peter@mrmortgage.ca.
Easy enough. There you go. This is Peter Puzo from Dominion Lending, top producers. Peter, always a pleasure, my friend. Thank you so much for doing
Thanks for having me, Mark.
No, I appreciate it. Thanks for watching. Take care, everyone. Be safe, stay positive, and follow us along on social, and we'll speak to you all soon. Take care. Bye-bye.